G'day. I'm keen to put together a video that just shows the importance of investing money, and obviously we all know that's important, but also how vital and how much more powerful it is that if you invest your money earlier. And obviously that's the effect of compound interest over a longer time frame, but I was keen to put a couple of examples together where if we're investing, let's say it's $2,000 per year by 5 years. And we're going to look at two examples, one where you start to invest from say age 38, putting $2,000 away per annum till age 43. Now we're going to give a return for the investor of 7.5%, and at the end of the time the money will be worth around $11,617 if my memory serves me right. So that's the $10,000 worth of principal, 5 times the $2,000 at 7.5%. So a very nice rate of return, one that we could average in a balanced portfolio. Now what I'm keen to do is that after that 5 years you do nothing, and then we just earn the 7.5%. So we're not taking tax into account here either. We're just looking at sheer return on investment. So let's fast forward. If we take the 43-year-old and we add 22 years on, so we're now a 65-year-old person, what it's going to be worth then without adding any more money to it. And that works out at $57,027. So obviously that money's compounded at the 7.5 and got to there. So quite a good result. But what I wanted to show you, what if we wound the clock back by 20 years to when you first made your investment? So we're now talking about investing at age 18, and we're going to save the $2,000 each year through to age 23. Of course, we're starting off with the same 7.5%, and at the end of the first 5 years, we've got the same amount invested as well. But instead of having 22 years worth of investing time frame, we've now got 42 that gets our person to age 65. This is where the difference is absolutely substantial. So what will compounding interest on this money will do over an extra 20 years, 42 years instead of 22, and that's where it'll get us up to, if I just check my figures, $242,000 per year. So, and if we break that down, for each contribution, so each $2,000 that's been put in over that time is worth not far under $50,000, whereas for each $2,000 that you've put in here is $11,405. So when we talk about returns, and we know that investing in wealth accumulation is all about time, this just proves that if you start earlier, and I know I can hear everyone saying, yes, but when you're 18 and early 20s you haven't got much money. That might be true, but you can always save something, and something is better than nothing. For those parents and grandparents who want to help their children and grandchildren out, well, these are some really strong reasons to do it. That extra 20 years, the difference between that and that, the outcome is 4.25 times the result. So it's huge result difference. So I just thought it was an interesting one to do, and it just shows the early contributions, the early saving that we make when we're younger are absolutely gold when you get to these sort of levels. Of course, we can continue to do this year in, year out and change these figures, but these are really meaningful, and I think it should be, it's an opportunity that everyone should try to take hold of. Thanks for listening.